can you just kind of give us your thoughts on the new tariff announcements the past day or two? And does that factor in here to why you expect tougher sledding for the market?
Hey, Kelly. Yeah. So obviously the market moves a lot on the tweets. Whatever Trump tweets out, the market's going to react. But we're looking at the actual economy as slowing sharply in the second half. And that has for decades had a strong relationship to the year-over-year change of the S&P 500. In addition, we agree with the Fed that inflation probably does breach 3% by year end at what's called the core personal consumption expenditure deflator, or core PCE. That's what they watch. And, it becomes a lot tougher in a soft stagflationary environment with inflation well above their 2% target and the economy slowing, which affects directly S&P 500 earnings, including big tech. That what happens is they get caught in stagflation. You get an echo of what we saw in the first 4 months of the year. Echo being half as bad, about 12% instead of intraday high to low, a little over 20%, but still an echo of what we just saw on the stagflationary trades.
Yeah, so in other words, and I think that's a good way to put it, we got kind of a preview in April of the panic that would ensue if we actually had higher inflation and a slower economy. And you think we end up with a little bit of that in the back half, notwithstanding the better jobs report lately, some of the more encouraging data, and those who say that inflation has been surprisingly kind of quiescent throughout all of this.
Well, inflation, of course, faced some easy anniversaries, so the base effects on a year-over-year basis. But on 6-month annualized and looking at the individual components of core PCE, everything from the sticky housing to super core being roughly where it was in the 4 years before the financial crisis 20 years ago, looking at durable goods probably going from deflation, which actually subtracts from inflation, to 0 to positive slightly based on all the leading indicators. I think inflation's pretty sticky. And to your point, Kelly, the first drop is usually fear of a worse outcome. Think of it as like a movie with the first of an original series. The second one is a little underwhelming because you already know what it is. You know what you fear, and it's usually less of a drop when the reality sets in.
Right, exactly. So, this comes, and I'm sure it hasn't escaped your notice, that a bunch of people are now upgrading their year-end price targets, as we just mentioned, because the market has been such a stalwart. What do you think explains that?
Well, right or wrong, we tend to make our forecasts not really connecting with what other strategists say. If you overlay strategist consensus for year end against the actual S&P 500 5 years on a, pardon me saying this, on a Bloomberg terminal, you'll see that the market is mostly just following what the strategists are following what the market's doing. They're not really thinking outside the box with big, bold numbers. So a lot of them, including today, that one you just mentioned, was a catch-up. But we actually see, again, some weakness in the second half. It is a seasonally fraught period, May to October, usually about 60 to 65% of the time in the last century. And I would be cautious because there are signs consumers could slow down. Just the early hours of Amazon Prime were pretty disappointing. And you're seeing data like that start to crop up. Slowing economy, slowing earnings, sticky inflation, less Fed cuts. You mentioned employment being okay. Why would they cut it all anytime soon? So we think there's going to be a pullback.